record on. So we're going to start with, I have them all on an Excel sheet so that we can get through them. And then when we get done with class, what I'll do is I'll open this sheet on Vanco so that you can also look at it there. So the first one was the Drysdale pizza. And so the first one was doing an average food check. So basically all you're doing is taking the sales divided by customers served. And so for X3, that was your sales, food sales, and then it told you the customers that you served. So X3, it was $12. X4, it was $13. So I'm just gonna keep going through these, but if you have a question, stop me. All right. All right, cost of food sold is just cost of food sold over food sales will give you the food cost percentage. We were doing this a lot when we were doing income statements, and the food department was coming out with a negative, had a net loss. So this is what we would go back and look at. So from the industry, that's a pretty good percentage. So it's just cost of food sold over sales. Say 20%, that's pretty darn good. Okay. Labor cost percentage. So your total labor costs. So this one is a little tricky. Remember what we did on income statements. Salaries plus benefits. That's your total labor cost. So for X3, it would be the 160 plus 550, which is the 210. For X3, it would be the 170 and the 55 added together. That's where the top numbers come from. And so those are your percentages. So a lot of these things you can use for predicting the future budgets. And you're going to see where we do that when we get into chapter 10, I guess. Is that we use the past percentages to predict what the future is going to be. We'll estimate what we think our new sale number will be. And then we go through this stuff and estimate what our expenses will be. Because like this type of a thing, you can see it stays fairly consistent. This stays fairly consistent. It should. All right, the next one is labor cost per customer served. I know these are not specific ratios that I gave you the other day, but they tell you what to do. So now you're taking your labor cost, dividing by your customers. So for X3, cost per customer was $3.15, but look what happened in X4. Okay, so look at these numbers right here. You had more labor costs, but you served less customers. Okay, more labor costs, but you served less customers. So that would be something that they would want to look at. And when we, again in chapter 10, we're going to look at variances. And so we're going to compare actual figures to what was budgeted. And labor is one of the set of variances that we're going to do. And we'll actually look at something like this. All right. So any questions on those first ones? Say those were all just kind of logic. Okay, then this next one is actually one that we looked at the other day. Number of times interest earned. And like I told you, the easiest way to do that one to get your top number is to take the net income plus income taxes plus interest.
Okay, now it connects.
And you can see with this income statement why you would want to do that, because it does not give you an EBIT. Questions? Okay. All right. So net income for X3 was 80 plus taxes is 30, so that's 110. Plus interest is 80, so that's where the 190 comes from. And then it's simply divided by interest, which was 80. So we cover our interest payments 2.375 times. Questions on that? So in the next year, if we don't take on any more debt, we would expect this to happen. Because as you pay on debt, the amount of interest theoretically decreases and you're paying more on the principal. So our EBIT this time is your net income of 86 plus taxes at 35, so we're up to 121, plus interest of 75 gives us the 196. And then we divide by 75, which is our interest on the bottom. Questions on that? Okay. So the next one basically takes this, adds the fixed charges to top and bottom. And the fixed charge in this case is that rent expense on the bottom. So that's rent on some type of a piece of equipment that if you don't pay the bill, they're going to come take it away. And so I started with these numbers, and all I did was add the 10 to top and bottom. Same here. In this case, I add 11 to top and bottom because that was the rent expense. So this is the number of times you cover that. So that's taking care of your interest and your fixed charges. And again, we increased from this year to this year because of our decrease in interest. The last one is profit margin, just net income to sales. Okay, just dividing, and that is a percent. So again, you have to look at everything. Up here, customers served, it's costing us a little bit more in labor. But when we go down here, our profit margin actually went up a little bit. The best thing that you can do with these, again, is to compare them year to year and compare yourself to industry.
I'm sorry, can you go back to the fixed charge coverage ratio? Because I got a different number.
What did you use for your numbers?
I used net income plus the interest expense plus the income taxes, and then I added occupation costs.
Okay, so what you want to add is that rent expense that's under other data.
Ah, okay.
That is your fixed charge. They should label it better.
That's where I messed up. I was assuming the occupation costs because of where they were in the statement were the inclusive of the fixed charges like rent, occupation of building was my assumption there.
Yeah.
Okay. Thank you.
Sure. Those should be set out. They should not be in your income statement. They should be set out in other information or other data. Okay, anything else with that one? All right, let's go to number 20. And I asked you to do a bunch of them extra on number 20 because we needed the practice. All right, so The first one, current ratio, remember, current assets, current liabilities. And you have to know what accounts are current and what accounts are not. In this case, they split it out for us, which is the whole purpose of making those balance sheets look pretty. It makes doing ratios much easier. So for the first one, we have current assets of 160, current liabilities of 110, and with these, you include all current liabilities. We don't care if there's notes in there. I mean, that's only a cash flow type of thing that you worry about. So we're just simply dividing the 160 by the 110. So for every dollar they owe, they have $1.45 to pay it off. 2007 looks even better. Again, current liabilities on the bottom, current assets on the top. So our current assets have increased. Okay, almost all of our accounts increased except the prepaids. And so therefore we look a little better here. We've got almost $2 to pay off every dollar that we owe. Now, I think we talked about this the other day. In manufacturing, retail, I want to see this to be a 3 or 4. Hospitality, you can get away with a lot less. And that's because of that inventory factor. Okay, the inventory factor. In manufacturing, as I mentioned the other day, they're going to have 3 inventory accounts, and they're going to be large. They're your materials. They are your work in process. And they're your finished goods. So just dollar-wise, they're going to be pretty large. In this industry, your inventory is primarily just food. So that should not be very large. Okay, acid test or quick ratio. So basically it starts with the current assets, but it takes off inventory and prepaids. So in this case, all that you should be in there is your cash, your marketable securities, and your accounts receivable. Just don't include inventory and prepaids in that top number. Bottom number stays the same. So in this case for X6, you would be adding the cash of 20, marketable securities of 20, accounts receivable of 90. So that's where the 130 comes from. So this is a pretty good position. Okay, they have over $1 to pay for every dollar. So quick cash, they know they can convert this stuff to quick cash. Again, it improves for X7. We have more current assets. So we have cash of 60, accounts receivable of 25, or I'm sorry, marketable securities of 25, and accounts receivable of 115. And that's where the 200 comes from. So we're even looking really good here. So a big difference that you saw was that the prepaids went down 10,000. Okay, inventory only went up 5,000, but your current assets total increased by 65,000. So a lot of that increase came right here with those 3 accounts. All right, questions? Okay, next one is accounts receivable turnover. Remember what I said. Turnover ratios, with the exception of inventory, always use sales on the top, and the bottom number is your average accounts receivable. Okay, bottom number is your average accounts receivable. Those are your 2 account receivable numbers. Going to add them together and divide by 2. That gives you your bottom number. And don't forget to do this. That's an error that you make. And honestly, some of the courses that I teach, we do the average. Some of the courses that I teach, we don't. It just depends on the book. But this book uses them, so that's what you need to do. So this is the number of times in a year that it converts to cash. Okay, so with this one, we need to convert it to days. So we take that and divide into 365. And so approximately 13, 14 days. Again, make sure these answers make sense. So 26 times a year, that's going to be a little bit more than twice a month. And so that makes sense. Okay. You have a couple return-ons. And remember, all the return-ons, top number is always net income. And be careful with this. Make sure you pick up the net income for X4. Because you have to average the bottom numbers, you can only do this for X4. So return on assets, it's going to give you the percentage that you're earning on your assets. Net income on the top, and then you have to average your assets. The other thing, make sure you do this addition and subtotal before you divide. Otherwise, what it's going to do is it's going to take this number, divide by 2, and then add it. It's the order of operations. Multiplication and division go first. So if you want it to add something first, you have to do that, total it, and then divide by 2. So that is your average assets. We're earning 13.51% on our assets. Questions? Okay. So we're going to do the same thing on our equity accounts. And again, this balance sheet is set up nice. So it has our totals. If you have to find the equity accounts, just make sure you add up common stock, APIC, retained earnings, and if there's treasury stock, as there is with this one, it's subtracted off. So you're going to average the two. That's your average equity. Divided into net income gives us 25.29%. So this is basically what the company is earning based on their stock and based on being in business, because it's your retained earnings. So that's a pretty good percentage. All right, questions on the first 5? Okay. All right, labor cost percentage, same type of thing that we did last time. So this one, you just have to go get the salaries and wages. Everything is in there. Divide it by your sales. So in this case, our labor costs are 27, almost 28% of our sales. And again, that's what you're going to use when you do your budgets for the next year. Now, this next one's a little tricky. I just leave it in there because I like it. So we want to find our income tax rate. If you remember, when we did income statements, we got it down to the very, very smallest number, and then we calculated our taxes. With this one, they don't give us that small number. So what you have to do before you can calculate this is you got to figure out what this number is. And if you look at the problem, you would take the net income, add back the taxes, and that would be that number. That would be the number that you're going to calculate the taxes on. And so that's just taking the income tax, calculating that the income before income tax. And so that's our tax rate. Did anybody figure that one out? Is anybody still there? To come to see if people are
Yep.
still here. Still there? Are you sure?
Yeah, sorry.
Still
Yeah,
here.
you have questions about the homework, if that's okay.
Okay, but let's finish this.
All right.
And I'll just warn you, I may or I may not answer them depending on what they are.
Okay.
Okay. All right, solvency ratio, assets to liabilities. You could do those for both years. So basically, we're looking at how many times our liabilities. So if I look at my assets, my liabilities were about half of financing those assets. So when it's a 2, it's about half. So this company is pretty much half equity, half liabilities. Hasn't really changed. Gone up a little bit. So there must be some additional liabilities in there. Just looking, they only went up a little bit, but they did borrow some more debt. They borrowed $50,000 more in debt, so that would increase this. And then profit margin, just like the last one, income over sales, 11.87%. Okay. So I said, why don't we do the inventory turnover? Just for practice. So let me just move this down. All right, let's do inventory turnover. So with inventory turnover, what number goes on the top? I guess we can't do that one. Never mind.
Yeah,
They
that's where I was getting confused because there was no cost of the inventory in anything.
There's no cost of goods sold. And they don't break the expenses out so that we can figure it out. All right, never mind. Had good intentions.
Thank you.
I was going crazy.
I looked at that thing so many times and I'm like, I have no idea how to calculate this without a cost.
Oh, I wrote, and actually now that I see in my book, I wrote no cost of goods sold. Okay, never mind. Go on to 21. Let's see, I think that's over here. All right, so this is the Mantle Inn. This one, we can do some extra ones. Okay. So first one was current ratio. Again, current assets, current liabilities. So for X1, current assets are 75, current liabilities are 55, so I have 1.36. But it actually got quite a bit better in X2. And if we look at our current assets, they bought marketable securities of 50,000 and all their other numbers went up. On the liability side, well, we really can't see anything. They only went up 5,000. So that was definitely an improvement from one year to the next. But look at the solvency ratio, assets to liabilities. So again, now it's not half. So if this was a 2, it would mean half of our assets were financed by liabilities. So in this case, the equity piece is financing more of our assets. So if you're a creditor, that's a good thing. If you're a stockholder, you may want more of it financed by debt, because then your share is, you would get more dividends, etc. But usually, again, and it depends on industry. Profit margin. Okay, big improvement here. Net income in the first year was only 10,000 compared to $1.2 million in sales. So it didn't even make a full percent. But then when we went to the next year, we got a nice percentage. So if you look at your income statement, sales increased by $200,000, but your cost of sales only increased by $80,000. And then other expenses. So of course, if we have more income, we have to pay more tax. So this is a nice improvement. We have total asset turnover, sales on the top, average total assets on the bottom. So this is a measure of efficiency of using your assets. This seems to be low, but again, it would depend on the industry. It depends on what happened last year in your particular company, because that may be okay. All right, accounts receivable turnover. This is going to tell you how quickly you collect your money. Sales again on the top, average receivables on the bottom. So I get a 24. So that means, again, about 15 days, and that's exactly what it comes out to be. Return on assets, net income on the top. You're using the same average total assets that you had before, so you don't have to redo it. So return on assets, not really making much on that those assets. Net income for return on equity with your average equity on the bottom. Again, not a huge percentage earned on your equity investment. Okay, we can do an inventory turnover here. So let's go do inventory turnover. And so with inventory turnover, we want cost of goods sold on the top. So that would be 700,000. And then we're going to have to find our average. Here, let me move this down. So this is inventory turnover. So we need cost of goods sold over average inventory. And so for inventory, we'd have to do the 10 plus 12 and then divide it by 2. That's going to give us 11. Oh, wow. We really don't keep our inventory on hand. So to figure out days. I would simply take the 365 divided by okay. Does that seem reasonable? 5, 6 days, I guess, depending on what type of a restaurant you have. That seems pretty quick to be turning over inventory, but. Okay, questions on those? Now, I know it doesn't cover all of them, but you've got your sheet. And I don't really remember which ones are on the homework assignment, but we'll look at that in a second. Okay, let's go back to 24. So these are looking at hospitality specific ratios. So this is a property that has 100 rooms, and we're doing it for September and October. And September, 30 days, October, 31. Remember, when you're doing available rooms, if you get huge numbers, it means you forgot to multiply by days. So with the first one, we had single rooms of 1,000, double rooms of 1,600. So for September, that's our total rooms sold. For our paid occupancy percentage, we want to know what percent of our actual rooms available we sold. So this is what we sold. This is what we could sell. So for September, you've got 100 rooms for 30 days, which is where the 3,000 comes from. So September, we were 86.67% filled. October, we had single rooms of 950, double of 1610, so a total of 2560. We have available 100 rooms for 31 days. And so our occupancy for October has decreased. These next two, you have a tendency to mix up, so be careful. Monthly ADR. So actual. So what did I actually sell? Try to remember them that way. So my rooms that I sold are on the bottom. Top number for both of these, for ADR and RevPAR, the top number is sales. ADR is based on what you sold. RevPAR is based on what you could sell. So just try to remember, RevPAR should always be a smaller number because it's a bigger number of rooms. So for this one, sales, rooms sold. So our average rate we were getting was $85. Sales, rooms sold for October. So we had a little bit more in sales in October. Even though we had less rooms, we got more per room. And if you look at the difference between the two, in October, we sold less single rooms and a few more double rooms. So you're getting more money. RevPAR says, okay, what could I make per room if I sold all my rooms? So if these are my sales and I sold all my rooms, this is what I would get per room. In October, this is my sales. These are the rooms that I could sell, and that would be my price per room. So it's kind of funny here. The actual was a little bit more from month to month based on selling all your rooms. But again, there's 100 extra rooms here. Price per room actually went down. Okay, questions? So we are good with these? I'm not hearing any response there.
Yes.
I'm good, yeah. Yeah.
Okay, so
Yeah, just, I know in the field working, another way we used to double check RevPAR is if we calculated our percentage of occupancy times what our ADR was.
yeah, that's another way you can do it. It's a good way to check it.
Yeah, that's how I used to double check things as well. Sometimes the numbers wouldn't look right,
Yeah.
and you could double check it.
Mm-hmm.
Sometimes it was a rounding issue if someone had rounded the occupancy.
So let's put that on here because that is another way. So if we wanted to do that, just to check the RevPAR, so we would take the 86% and multiply by, comes out the same. Good way to check yourself. Well, it came out okay. All right. Questions?
None yet.
All right. So we'll stop and I'll share. So what I will do is I'll save that file and I'll upload it. And you guys will have it to look at if you want to. So what was the question about the homework?
I couldn't find marketable securities. I had trouble finding it.
So if you can't find it, then it's probably not there. So are you talking 15? If it's
Yeah.
not there, don't worry about it.
Oh,
Okay, so if it's not there, don't worry about it.
okay.
You're not always gonna have everything. But I try to, when I do my notes for you guys, I try to include everything that you could see. Though you
Got
not
it.
necessarily see. So just while we're here with that homework, make sure you follow my directions on Vanco Hall because I'm having you do extra ratios. And then I've also taken some out. So make sure you follow what's on there.
Right.
Because I added 1, 2, 3, 4, 5, 6, 7, 8, 9, 8, I think. So I added 8 ratios to Duke Snyder, but I also took off a couple. And then the Hodges, I want you to do 3 of them, but do them for both years. So I say, make sure you follow directions on Vanco Hall. The other thing I'm going to tell you, because I won't see you before your test on Friday, this test is different. It's many questions, and you have to fill in the blank with your answer. Do not put dollar signs, any words. All you do is put the answer in the box, or it will mark it wrong. Okay? So and you can't go back. So
Even for
answer-
percentages,
What's that?
even for percentages, like don't put the percent sign.
Don't put anything in there. Just put the numbers with 2 decimal places.
Okay.
I mean, when I put these together, I put in like 4 or 5 choices of what I think how you might write the answer. But if you just stick to numbers with 2 decimal places, you should be fine. But just remember, you can't go back. So answer the question before you go on to the next one. There's 18 questions, just so you know ahead of time how many there are. And I gave you an hour, I think. All right.
So
So
is
you're
it going to be all of the different ratios and stuff? Not
Mhm.
anything else?
correct.
Okay.
That's why we only spend a week on this one. It's easy.
Yeah, that doesn't sound too bad.
Okay.
Are our
And-
ratios due tonight or tomorrow?
Hang on,
I think they're tonight.
What is today? Yes, they are due tonight, so no St. Patrick's Day.
And also,
yes.
just to clarify, for number 17, the Hodges, it says for both years, and it's 2 months are listed. I'm not looking in a different problem for another year worth of data for this hotel, am I?
Oh, did I write that?
On Vanco, it says do A, D, and E for both years.
Okay, I'll fix it.
Okay.
I'll do it right
Considering
now.
I went looking for something that didn't exist on the others, I just want to make sure.
All right, I'm changing it to months as we speak.
Okay.
Anything else?
No, I'm good.
All right. I'm gonna get out a little bit early today, like 3 minutes, no, 6 minutes. Okay. I'm gonna stop.